Let's connect with Samiran Chakraborty, Regional Head of Research with Standard Chartered Bank. Samiran, good morning. Thank you for joining us. The CPI number disappointed. Do you think the WPI number could also disappoint us today later in the day?
Well, we were looking at somewhat moderation in the WPI print compared to last month's print. So looking at around a 5% mark on WPI, but clearly with the CPI number slightly surprising us on the upside, there is a chance that the number could be a little higher than that. We'll have to see to what extent this WPI also reflects the higher vegetable prices, which has been the case for CPI.
Fuel prices have risen and fuel price hikes are likely to continue. How do you see fuel inflation shaping up? Or also, do you see core WPI to inch up as input prices remain firm?
Yeah, so if you look at this July versus the last July, in both the years, there have been significant fuel price hikes on both petrol and diesel. In petrol 2 rupees and in diesel 1 rupee. So in that sense, the base effect of both the years will probably cancel out. So not expecting the fuel inflation to increase substantially on the back of that. But you're right that the core inflation part of it is of somewhat risk, because as growth is likely to pick up, there would be pressure on core inflation with more and more companies getting back their pricing power. And a little bit of exchange rate depreciation that we have seen would affect the WPI much more than the CPI. So even from that perspective, the core inflation could get impacted.
Food inflation pressures, Samiran, have persisted. How do you see monsoon to further impact food inflation? And what are the steps you expect from government in terms of managing food inflation?
For the time being, I think the peak of the food inflation is over. We have seen most of the food prices starting to correct to some extent in August. But the real risk is in October, November, when these produce are going to hit the market. At that time, because of delayed sowing, if we see a period where the supply falls short of the demand, then we could see renewed price pressures coming at that point of time. So not right now, but probably in October, November, we could see another spike in food prices, which could start worrying us. In terms of taking steps, clearly a lot needs to be done from increasing food production, which is more a medium-term issue, to directly addressing a lot of supply-side concerns on distribution as well as storage. But in the very near term, I think the big step that's needed is to reduce the huge gap between the wholesale price and the retail price, which for food items is often more than 100%. So I think that's the area where a lot of focus will be required.
Adjusted for favorable base effects, how do you see the CPI and WPI shaping over FY15 then, Samiran? Many economists have stated that meeting CPI target of 6% by Jan 2016 will be a challenge. In that case, how do you see the RBI stance on rates evolving over the course of the financial year?
Well, for this year, the base effect is little odd, because till about November, the base effect is favorable, and post that, the base effect turns unfavorable. But I think the other question that you are asking, which is about the risk to the 6% inflation target for 2016 January, to be fair, this is almost 1.5 years ahead of us, and it's difficult to predict different kinds of supply side shocks and its impact on second round impact on demand side inflation over such a long period of time. Especially for CPI with 50% weightage on food, we could see several supply side shocks between now and then. So I think it is probably fair to say that the 8% January 2015 target can still be met. For January 2016, we would still have to see inflation sustaining at low levels with lower inflationary expectations to make that happen.
Well, the IIP for June was much lower than expectations. How do you see industrial activity and the overall GDP growth picking up? And also, what are your expectations for the Q1 GDP or from the Q1 GDP?
Well, IIP obviously was much lower than what we were anticipating. But if you go back to the breakdown of this number, the big decline in sugar production of more than 70%, I think that has been the primary driver behind this drop. So if the issues with respect to sugar mills in Uttar Pradesh gets resolved, then possibly this can pick up and IIP can get back to a higher growth trajectory. For the first quarter, we were anticipating a close to 6% GDP growth number. Obviously, this low IIP print for June has put some question marks on that. Maybe we will get the GDP number a couple of notches below that, but still it will be a significant improvement over the 4.6% GDP print for Q4 fiscal year 14. But we will also hasten to add that there's still some time before the indicators of cyclical recovery are firmly in place on both consumption as well as on investment side. So we are still maintaining a somewhat 5.3 to 5.5% GDP growth number for the full year.
So, Samiran, trade data is likely to be released next week. Your expectations on the same, and also how do you see export growth picking up in the light of global recovery?
We are expecting about a $10 billion of trade deficit for the month of July. This will be slightly lower than the last month in June. This is primarily because we are expecting the gold import demand, which in June was very high at more than $3 billion. That has probably moderated a bit. That's what our guess is. And if that happens, then we'll probably see a less than 10 billion print again on the trade deficit number. We see the export growth numbers to kind of keep on maintaining a decent momentum. But we are also worried of the fact that geopolitical tensions, etc., might mean that global growth in the second half might get impacted a bit. In fact, for US and Europe, we are seeing only a very tepid recovery. If that's the case, then possibly we will not see a big surprise on the export number on the upside as well. So having something in the range of 7 to 10% export growth for the full year.